Hey guys, in this video I'm going to lay out 3 rules I use to consistently pick winning dividend stocks. I am primarily a long-term dividend growth investor with the vast majority of my portfolio invested in stocks that typically raise their dividends every year. When you're buying stocks for the dividend, you are investing for long-term passive cash flow, and there are many important factors you need to consider to ensure that this cash flow remains reliable for years to come. The first and most important rule is to buy stocks that have consistently raised their dividends in the past. You always want to look at a stock's dividend history before buying it. Dividend cuts and suspensions are something you want to avoid at all costs. Of course, there are some situations that are unforeseeable, but most dividend cuts can be avoided simply by choosing a company with a solid dividend history. If a company has cut its dividend in the past, it is likely to do so again if times get tough. Ideally, your stock should have a long history of consistently raising its dividend year after year after year. The best examples of this are the Dividend Kings, a group of stocks that have raised their dividend every year for 50 years or more. I own 4 of these stocks myself. Altria with 51 years of dividend increases, Johnson & Johnson with 58 years, 3M with 62, and Procter & Gamble with 64 years of consecutive dividend increases. The fact that companies can and do consistently raise their dividends is what makes dividend investing so great as a strategy for long-term cash flow, as opposed to investing in bonds, for example. For illustrative purposes, I also want to take a look at one of my investments that was not such a great dividend stock pick. That's Carnival Cruise Line's ticker symbol CCL. I was unfortunate enough to invest in this company right before the pandemic hit, and obviously, the cruise industry has been absolutely devastated since then. CCL and other cruise line stocks had no choice but to cut their dividends completely. This situation was obviously very difficult to foresee, but I had known going in that their dividend may not be reliable. You can see from this chart of their dividend history that they have cut their dividend in the past in 2008, and have had periods of stagnation with no dividend increases. These are red flags of a business model that isn't consistent or a management team that is not fully committed to the dividend. For this reason, I kept my position quite small. You want a company that not only maintains its dividend, but consistently raises it, not only for your own peace of mind of the safety of your dividend, but because of a concept called yield on cost. Most companies do not pay very high yields, usually in the 2 to 4% range. But if a company raises its dividend over time, your original cost stays the same, but the dividends you receive keep increasing, so your effective yield keeps going up. Say, for example, that you bought AbbVie, ticker symbol ABBV, at current prices of around $95. AbbVie pays $4.72 per year in dividends, giving you a current yield of 5%. Last year, AbbVie raised their dividend by 10%, and if they continued to do that every year for the next 10 years, you would now be getting paid $12.42 per year, giving you a yield on cost of nearly 13%. This is only a simple yield on cost, meaning you bought the stock once and simply held it for 10 years, not reinvesting any dividends. If you had continually reinvested your dividends for those 10 years, you could be yielding somewhere around 23% on your original cost. This calculation is trickier. To arrive at this number, I assume that AbbVie's stock price would appreciate at 7% every year for the next 10 years. Which isn't likely to happen, as stocks tend to go up and down a lot some years and stay flat other years, not a consistent 7% every year. But still, this shows the long-term double compounding magic that happens when you reinvest dividends in a stock that continuously raises its dividend. To get a good visual look at a stock's long-term dividend history, I recommend using Seeking Alpha. They provide charts and split-adjusted dividends going as far back as 1989. You can also find other useful information here like earnings and free cash flow payout ratios, as well as historical yield on cost. I find Seeking Alpha to be a very helpful tool when screening stocks and getting raw data, but I always recommend going through the company's earnings reports and calculating the numbers yourself, because the information you find on these websites is not always 100% accurate. Rule 2 is to never buy a stock just for the dividend, and don't just buy the highest yield stock you can find. This might seem paradoxical, considering I just said the most important thing to consider was the stock's dividend history. But you need to keep in mind that a stock is more than its dividend, and ultimately the fundamentals of the company will determine whether it's able to sustain and grow its dividend in the long term. A high yield can often be deceptively attractive if the fundamentals do not back it up. Often, the best dividend stocks in the long term have low current yields but enormous potential for future growth. So once you've narrowed down your list to companies with solid dividend growth track records, you need to consider the quality of the business itself. This is the most difficult step, and like any other stock investment, it will require that you fundamentally analyze and understand the businesses that you are considering buying. What you are looking for is a relatively safe company that has future growth potential. That means a solid balance sheet, a consistent business model that provides reliable cash flow in most economic environments, and a trend of increasing revenues and profits, or a good management team with a clear plan to grow into the future. Dividend growth stocks usually fall into three basic categories: high yield, low growth, low yield and high growth, and everything in between. You should consider your time horizon. If you're planning to retire in the next 5 years, then you want an extremely safe business model with a high yield, and you don't care as much about the growth potential. You might consider looking into utilities, telecoms, and consumer non-cyclical stocks. If you are young or are planning to remain invested for decades to come, then it is often better to choose a stock that has a low current yield and possibly a bit more volatile business model, but has the potential to deliver double-digit growth going out for decades to come. These types of companies can be found in many different industries, but I particularly like the consumer, cyclical, and technology sectors. Starbucks and Microsoft are two stocks that I own in these sectors that have already delivered amazing returns for me, and I believe will continue to experience not only great capital appreciation, but enormous yield on cost in the long term. The third rule is to consider valuation, but above all, get invested. Once you've settled on a group of great stocks with solid business models that you understand well, it's time to start actually buying. Valuation is important when buying stocks. You don't want to overpay for an investment. But if you've found a company you really love and believe in long term, I think the most important thing is to just get invested. Especially if you have access to commission-free investing and fractional shares, you can start a very small position and average in over time. Too often people make the mistake of not buying a stock that they love because it appears overvalued, or they are waiting for it to hit a certain price point. Then the stock keeps going up and you end up never investing. The opposite can happen as well. You see the stock keeps going up and you end up getting FOMO, investing too much too fast, and then the stock drops and you end up selling out, only for it to go back up. I have certainly fallen into this trap myself. I bought Procter & Gamble stock 2 years ago at $80.25. It was just a small starter position and I planned to continue to average in, but the stock just kept going up and currently it's trading at almost $140, over a 70% gain on my initial purchase price, not even accounting for dividends. This year, I again had the opportunity to buy this stock in the high 90s, but it just didn't feel like it was as good of a value and I never ended up buying again. Timing the market is exceedingly difficult to do consistently. That's why I recommend dollar cost averaging for any long-term positions. If you consistently invest, over time you will get the best average price. And if the stock starts to dip, you can invest a little heavier and get your cost basis lower. It is important when investing for the very long term that you are not only willing but happy to keep buying the company if the stock price goes lower. So long as the business's fundamentals don't change radically, you should be happy to see your investment go down in the short term. That just provides you with a better investing opportunity. And the longer the stock price is suppressed, the better your yield on cost will be in the long term. If you follow all the steps in this video, I believe the chances of you losing money over the long term are very low. The chances of you creating and sustaining a growing source of passive income are excellent. Dividend investing may not be the most exciting. You certainly won't get rich overnight, and it isn't for everyone. But I believe it provides one of the most accessible and reliable ways for anyone to set themselves up for a comfortable retirement and financial freedom. Thanks for watching the video today. If you enjoyed, don't forget to like, comment, and subscribe for more similar content in the future. I'll see you in the next one.